January 30th, 2026 wasn't a normal down day in silver. It was a collapse. In a matter of hours, price fell from roughly $121 to near $70, a $51 move, straight down. No grind, no warning, just a vertical drop, the kind of move that doesn't happen in functioning markets. It was the most violent single-day sell-off in silver since 1980. Statisticians labeled it a Six Sigma event, something that on paper shouldn't happen at all. In the same 48-hour window, more than $7 trillion was wiped off global asset markets. Retail traders were hit with margin calls faster than they could react. Positions were liquidated automatically. Accounts vanished in real time. At the physical level, the disconnect was immediate. Bullion dealers across major hubs, Dubai, Switzerland, parts of Asia, reported the same thing. No silver available. Not low inventory, zero. Empty shelves. And while most of the world was scrambling, one participant was on the other side of that trade, completely composed. He doesn't do interviews, he doesn't respond to press inquiries. He operates quietly out of a small office in Gibraltar, far from New York, far from London, and far from the spotlight. On that day, he held the largest short position in silver anywhere in the world, roughly 30,000 contracts. That's the equivalent of about 450 metric tons of silver. According to Bloomberg reporting published February 5th, the paper profit on that position was estimated around $288 million. After netting earlier drawdowns, roughly $144 million remained. One trade, one event, nearly $250 million in gross gains. But focusing on him misses the point. This isn't a story about a mysterious trader making money. What matters is why January 30th unfolded the way it did, what surfaced in the data days later, and what is still developing as this market digests the damage. There is a structural fracture in silver that most coverage is completely ignoring. Later in this video, I'm going to walk through the February 5th data release from Shanghai, specifically the trading volume and physical pricing signals that came out that morning. Almost no one is talking about it, and that's a mistake. It may be the most important signal in the entire commodities complex right now. I'll also explain who this trader actually is, how he built his position, and why his identity changes how this move should be interpreted. By the end, you'll understand why this wasn't a random crash. Welcome to Quiet Invest. If you're new here, subscribe. If you find this analysis useful, hit like. It helps the channel reach people who actually want depth instead of headlines. Now, let's break down what really happened. Every major outlet ran the same explanation. Bloomberg, CNBC, everyone. Silver crashes, gold sells off, Fed nomination rattles markets. That's the surface narrative. Here's what was conveniently minimized. Silver futures on COMEX dropped more than 31% in a single session, the worst day since March 1980. Spot silver fell roughly 28%. Gold, by comparison, declined about 9%. Pause on that ratio. Silver fell more than 3 times as much as gold. If this were simply about a stronger dollar or shifting rate expectations, that doesn't make sense. Both metals are dollar-denominated. Both respond to macro tightening, yet silver was annihilated while gold barely suffered a bad day. That imbalance is the signal, and almost no one is explaining it. The mainstream explanation goes like this. On January 30th, President Trump nominated Kevin Warsh as the next Federal Reserve Chair. Warsh is viewed as a hawk. Markets priced in higher rates for longer. The dollar jumped, precious metals sold off. End of story. That explanation isn't false, it's just incomplete. It maybe accounts for 10% of what actually happened. The remaining 90% is what makes this event comparable to 1980, not in scale yet, but in structure. Beneath the headlines was a forced unwind of leveraged long positions paired with aggressive, well-timed short selling. And this isn't speculation, the positioning data confirms it. CFTC reports showed that speculative net long exposure in silver was near extreme levels going into that week. The market was crowded, leveraged, and fragile. Once price broke, liquidation cascaded, stops triggered, margin thresholds failed, and the selling fed on itself. That's where this story actually begins. By the end of January, the silver market wasn't just bullish, it was dangerously one-sided. Positioning was stretched to an extreme. Leverage was everywhere. The trade had become consensus, and when everyone is leaning the same way, the smallest shove can knock the whole structure over. That shove arrived quickly. According to analysis circulated internally at Morgan Stanley, quantitative teams flagged what they described as large-scale forced rebalancing inside leveraged silver products. This wasn't discretionary selling, it was mechanical. One product alone, the iShares Silver Trust, was hit with roughly $3.5 billion in forced sales on January 30th. One fund, one day. Then the accelerant was added. The CME Group raised margin requirements on COMEX silver futures from 11% to 15% in the middle of the sell-off. That decision matters more than most people realize. Raising margins during a decline doesn't calm markets, it forces selling. Here's the mechanics. When margin requirements rise, every leveraged trader has to post more collateral immediately. If they can't, their broker liquidates the position automatically. Those contracts don't wait for a bid, they're dumped into an already falling market. Price drops further, that triggers more margin calls, more liquidations. The loop feeds itself. That's how crashes become cascades.
And this was precisely the environment one trader had prepared for. Earlier, I mentioned that someone was positioned on the opposite side of this unwind, quietly, deliberately, and far from the Western financial centers. Now it's time to be specific. His name is Beyond Shaming. Once you understand his track record, his presence in this move stops looking random. Over the past 4 years, Beyond built a reputation as one of the most effective metals traders operating in Asia. Since 2022, he has reportedly generated more than $3 billion by holding long positions in gold on the Shanghai Futures Exchange. Not a one-off win, a sustained, multi-year thesis that paid. And then, as silver went vertical, he flipped. According to Bloomberg reporting published February 5, 2026, Beyond began accumulating short exposure to silver through his brokerage, GNI Futures, on the Shanghai Futures Exchange. Exchange data shows that by January 28, 2 days before the crash, his silver short position had already grown to roughly 18,000 contracts. Then came the key moment. On January 30th, the exact day silver peaked in Shanghai, his short exposure jumped again by about 10,000 contracts, total position close to 30,000 contracts. That's roughly 450 metric tons of silver in notional terms. To be precise, this doesn't mean he caused the crash. There's no evidence he had advanced knowledge of the Fed nomination or engineered the sell-off. That's not the claim. What is clear is that a trader with a proven multi-billion-dollar track record in metals placed a massive directional bet against silver at the exact moment the market was most fragile. And the timing is hard to ignore. Bloomberg's analysis indicates that he began probing the short side as early as November 2025, attempting to identify a top. Some of those early positions lost money. Before that, he had actually been long silver. In August 2025 alone, those long trades reportedly earned him more than 1.3 billion yuan. He profited on the way up, then reversed and profited on the way down. That pattern matters. My assessment, after sitting with this all week, is straightforward. This wasn't luck. Beyond read the structure correctly. Silver had gone parabolic. From early 2025 to late January 2026, price ran from roughly $30 to over $121, a 4x move in less than a year. Moves like that don't require bad fundamentals to reverse. They collapse under their own leverage. I've seen this setup repeatedly across commodity markets. When an asset quadruples in 12 months, leverage doesn't just increase, it metastasizes. Futures, options, ETFs, structured products, everything piles in. And once that leverage reaches a critical mass, the market becomes a pressure vessel. All it needs is a spark. He recognized the excess early. Speculative positioning had reached unstable levels. Leverage was layered on top of leverage, and instead of betting on a continuation, he bet on gravity. Eventually, gravity won. But here's the detail that's genuinely unsettling once you sit with it. One individual trader, operating through a single brokerage, held the largest net short position on the entire Shanghai Futures Exchange, not spread across institutions, not fragmented, concentrated. Personal capital in select client portfolios aligned into the same directional wager. When the unwind hit, he walked away with at least $144 million in profit, while the rest of the market was being liquidated around him. Some independent estimates, including analysis circulating from Cryptopolitan, put the total gain much higher, closer to $500 million.
You can decide whether that timing was pure execution skill or something more. Hold that thought, because the next layer makes this far more troubling. While paper silver on COMEX was collapsing towards $70, the physical market was doing the opposite. And this is where the story stops behaving like a normal commodity cycle. I've followed precious metals long enough to expect volatility. Dislocations happen. Temporary spreads show up during stress. But what unfolded in early February was something I've never seen before. On February 2nd, the same ounce of silver was trading at radically different prices depending on geography. In New York, COMEX pricing had silver near $80. In Japan, that identical ounce was trading closer to $120. Same metal, same day, roughly a 50% gap. This wasn't isolated. On the Shanghai Gold Exchange, prices were around $111. India was near $93. Kuwait traded close to $106. Dubai hovered around $91, with premiums running 15 to 18% above quoted spot. Every major regional market was assigning a different value to silver at the same moment in time. Shanika Pereira described this as the largest sustained divergence ever recorded in precious metals pricing. And that wording matters. Sustained, not a flash imbalance, not a temporary glitch. In a functioning global market, spreads like this shouldn't last more than minutes. Arbitrage desks are supposed to step in, buy cheap in one market, sell high in another, and collapse the gap. That mechanism is what keeps prices aligned. Except, it wasn't working. According to analysis published by Trading Key, silver lease rates had surged into the 7 to 8% range. Once you factor in borrowing costs, freight, insurance, and timing risk, the arbitrage math stops working. There's no profit left. Moving metal from west to east becomes economically impossible. The price linking mechanism had effectively snapped, and the physical shortage confirmed it. Reporting from the Khaleej Times on January 31st showed that physical silver bars in Dubai were simply unavailable. Dealers told the paper that inventories were exhausted. Buyers were reportedly paying more than 2,000 dirhams per kilogram above prevailing prices just to secure metal. One dealer, Ammar Akrami of Almanar Gold and Diamonds, was quoted directly, "Silver is not available in the market right now." Similar reports surfaced from Switzerland. According to industry commentary from bullion insider Clive Thompson, one of the country's largest dealers had zero silver inventory, not low supply, none, no scheduled replenishment for weeks. When silver did come in from customer sellbacks, it was immediately resold. Nothing stayed on the shelf. Gold wasn't far behind. Coins and small bars were gone entirely. Only large format bars, 250 gram, 500 gram, and 1 kilogram sizes were still available. Paper prices were collapsing, physical metal was disappearing, and those two realities were no longer connected. Now I want you to slow down and connect these pieces, because this is where the contradiction becomes impossible to ignore. On one side, COMEX pricing implied silver was worth about $80 an ounce. In Shanghai, pricing stayed north of $100. In Dubai, dealers weren't quoting prices at all because metal simply wasn't available. In Switzerland, inventories were effectively non-existent. At the same time, estimates put the paper-to-physical ratio on COMEX at roughly 350 to 1.
That means for every ounce of real deliverable silver, there are around 350 claims tied to it. Sit with that for a moment. 350 claims on a single ounce. You don't need a PhD in finance to understand that this structure only works as long as no one asks for delivery at scale. The math doesn't reconcile. And then the imbalance intensified.
February 5th is the date that changes the entire story, and strangely, it's barely being discussed. According to trading data from the Shanghai Futures Exchange, during the morning session alone on February 5th, more than 1.39 million contracts traded on the April silver contract. To understand how extreme that is, you need the contract size. Each SHFE silver contract represents 15 kilograms of silver. When you convert that volume, the morning session alone represented roughly 674 million ounces of silver equivalent. When you include all silver contracts traded that same morning, total volume reached approximately 1.34 billion ounces. Now compare that to reality. Global silver mining output is roughly 800 to 850 million ounces per year. In a single morning, on a single exchange, traders transacted paper claims equivalent to nearly twice the entire world's annual silver production. When I first ran the numbers, I assumed there had to be an error. I cross-checked the contract specifications, 15 kilograms per lot. The arithmetic checks out every time. This wasn't retail traders. This wasn't normal liquidity. This was institutional-scale coordinated selling pressure, effectively an attempt to overwhelm price discovery in the Chinese silver market. And here's the part that matters most. Despite that avalanche of paper selling, despite dumping the equivalent of a year and a half of global mine supply in a few hours, Shanghai silver did not break relative to Western pricing. The price was pushed down, yes, but it remained at a meaningful premium to COMEX. At the close, Shanghai silver was still trading roughly $12 above COMEX prices, and the premium quickly rebounded towards $17 per ounce. Even more telling, the market stayed in backwardation, meaning near-term delivery continued to cost more than future delivery. That is not a paper market signal. That is a physical tightness signal. No amount of futures volume eliminated it. That was the moment everything clicked for me. You can unload staggering amounts of paper silver onto the market, and yet the physical premium refuses to disappear. That tells you exactly where the leverage really is. Not with paper traders, with whoever controls the actual metal. And there's one more data point that reinforces this picture. According to CEIC, physical silver inventories held at the Shanghai Futures Exchange have been falling rapidly. Stocks declined from roughly 482 metric tons to 455, then from 449 tons on February 3rd to 423 tons on February 4th. That's a 26-ton drawdown in a single day. For perspective, SHFE silver inventories peaked near 3,091 tons in January 2021. At current levels, inventories are down roughly 86% from that high. Paper volume exploded, physical supply vanished, and the gap between them keeps widening. The metal isn't just being repriced, it's being removed. Silver is physically leaving exchange warehouses. This isn't a paper reshuffle or an accounting trick. Real bars are being withdrawn, loaded, and taken out of circulation. And at the same time, China's industrial engine, solar manufacturing, electronics, advanced tech fabrication, is consuming silver faster than replacement supply can keep up. That's what makes the January 30th crash so paradoxical. If you only followed headlines, you'd assume the silver story is over. Bubble popped, speculation flushed, move on. But when you look underneath the surface, the fundamentals are signaling the opposite. This is where I want to pause and give you my own assessment, because context matters. I've tracked silver supply and demand dynamics for a long time. What's unfolding now doesn't resemble anything I've seen before in commodities. On January 1, 2026, the government of China officially reclassified silver as a strategic resource.
That's not a cosmetic label, that's a policy shift, and a major one, and it received almost no serious coverage in Western financial media. Only 44 companies were granted authorization to export silver for 2026 and 2027. Those approvals cover roughly 121 million ounces per year, representing an estimated 60 to 70% of all refined silver traded globally. Think carefully about what that implies. China is the world's largest silver refiner, and it just placed a state-controlled choke point on outbound supply. Governments don't designate commodities as strategic unless they intend to retain them. You don't restrict exports of something you believe is abundant or replaceable. I've said this repeatedly, and it's worth repeating again. When a government begins hoarding a commodity and limiting its flow, that is one of the clearest signals you'll ever get about how it views future value. And this wasn't the only signal.
Samsung, one of the largest technology manufacturers on the planet, recently secured 100% of the output from the La Perla silver mine for the next 2 years. The deal involved a direct prepayment of roughly $7 million. Notice what they didn't do. They didn't buy futures on COMEX. They didn't touch an ETF. They didn't rely on paper contracts. They went straight to the source and locked up every ounce before it left the ground. That decision tells you exactly how sophisticated industrial buyers are thinking right now. When a company of that scale bypasses the entire exchange system and negotiates directly with a mine, it's because they don't trust the paper market to deliver when it matters. And that, to me, is the central insight tying all of this together. The smartest, most capitalized players are no longer expressing their silver exposure through paper. They're securing physical supply upstream before it ever touches an exchange. That should tell you everything about where confidence still exists and where it no longer does. They aren't expressing demand through futures anymore. They're going straight to the physical supply chain. And I want to pause here because this point matters more than any price chart. A sovereign government is restricting silver exports. A global technology conglomerate is pre-buying mine output years in advance, and the exchanges where silver is supposedly priced are no longer trusted to deliver metal when it's needed. If that doesn't force you to rethink how this market actually functions, nothing will. There's also a timeline problem that almost no one in mainstream finance wants to touch. Even at today's prices, bringing a new primary silver mine online takes 7 to 10 years. That means the supply response to current demand pressures won't meaningfully arrive until the early 2030s. For the next decade, supply is effectively locked. At the same time, silver has been running a structural deficit for 6 consecutive years, and that gap isn't narrowing, it's widening. Solar manufacturing alone consumed more than 200 million ounces last year. Add electric vehicles, AI hardware, data centers, 5G infrastructure, and medical technology, and you're looking at demand streams that are not discretionary. Silver isn't optional in these applications. You can't substitute it out of a solar cell. The physics doesn't allow it. Then there's another signal that quietly crossed the tape. According to a February 3rd press release, the state of Wyoming selected the Wyoming Reserve to vault its physical precious metals holdings. That means a U.S. state government is now actively securing gold and silver storage within its own borders. That is not a routine administrative decision. When state governments begin prioritizing direct custody of precious metals, it tells you institutional assumptions are changing. So let me be intellectually honest and lay out the bearish case first because it deserves to be addressed. The argument is simple. A hawkish Federal Reserve chair implies higher rates for longer. A stronger dollar pressures metals. Silver ran too far too fast and needed to correct. Analysts at J.P. Morgan have floated scenarios where silver revisits $50, and Byung-Chae Ming, a trader who has made billions in metals, has been positioned on the short side. If someone with that track record sees downside, it's not something you dismiss casually. Add to that the volatility. Silver dropped $51 in a single day. If you're leveraged, that kind of move doesn't hurt, it erases you. That risk is real, and pretending otherwise would be dishonest.
Now here's where my view diverges from the bearish narrative, and I'm going to be very direct about this. The January 30th collapse was a leverage event, not a fundamental one, and the difference between those two is everything. Leverage events unwind positioning, fundamental events change reality.
What happened that day flushed excess, broke crowded trades, and exposed fragility in the paper market. What it did not do was fix the physical imbalance, expand supply, or eliminate demand. And that distinction is what this entire story turns on. A leverage event means price moved because of positioning, not because of value. It's the forced unwinding of bets, not a reassessment of what the asset is actually worth. And every piece of physical market evidence confirms that's exactly what this was. During the worst of the sell-off, physical silver in Shanghai held above $100. In Dubai, it wasn't available at any price. In Switzerland, dealers had nothing on their shelves. Meanwhile, the paper market printed prices near $80. Paper said 80. Physical said, you can't have it at 100. That isn't a bearish market, that's a broken pricing mechanism. More importantly, the fundamentals behind that physical tightness didn't weaken after the crash, they intensified. Silver remains in a structural supply deficit with no realistic supply response for 7 to 10 years. China restricted exports starting January 1st. Industrial demand from solar manufacturing, AI infrastructure, and electric vehicles continues to accelerate quarter after quarter. On the inventory side, COMEX lost roughly 26% of registered silver in a single week. LBMA holdings are down about 40% from 2021 levels. Silver lease rates didn't just spike, they went from roughly 0.5% to around 8% and stayed there. That is not what a burst bubble looks like. That's what it looks like when physical supply is being drained while the paper market continues to price abundance. Now layer in the macro backdrop, because this is where the conviction strengthens. Goldman Sachs has discussed gold targets around $5,400. Bank of America has floated levels closer to $6,300. Even J.P. Morgan, not exactly known for hyperbole, has referenced gold scenarios in that same range. Historically, silver does not maintain a 55-to-1 ratio with gold during a secular gold bull market. When gold trends higher over sustained periods, that ratio compresses. If gold moves towards $6,000 and the ratio tightens to even 45-to-1, silver lands north of $130. A tighter compression puts it closer to $150. Now, let me be explicit. This is my opinion, not financial advice. But in my view, this is one of the most asymmetric setups I've seen in commodity markets. The risk-reward profile for patient physical holders versus leveraged paper traders isn't even comparable. Paper markets can suppress price in the short term. We just watch that happen in real time. What they cannot do is manufacture physical silver when inventories are being pulled out of the system. And eventually, always eventually, physical reality wins. So I'll leave you with this. The paper market says silver is $76. The physical market says you can't buy it at 100. One of those numbers is lying. And in the history of commodity markets, when paper and physical stay this far apart for this long, it's always the paper market that eventually has to reconcile with reality. Now I want to hear from you. Where do you think silver ends 2026? Does paper control hold, or does physical scarcity take over? Drop your price target in the comments. I read them all, and I'll pin the strongest analysis. If this breakdown helped you understand what actually happened, share it with someone who's still confused. And if you want more independent, data-driven analysis like this, subscribe. This is Quiet Invest, because the real story is never on the surface.